Welcome to tonight's live streaming where we are going to talk retirement income. So many of you have worked for 20 years, 30 years, 40, 50 years, accumulating wealth, and now it's time to distribute it. Step 2 of the retirement success plan is to develop that income plan so we can be intelligent about which accounts we're taking money from, how much income we're taking, and pay attention to the amount of taxes that we're paying. So tonight's format is going to be pretty straightforward. We're going to talk about income planning. I'm going to go through a dividend example. I'm going to go through an annuity example, talk a little bit about bonds, talk a little bit about real estate, and then tie that all into retirement planning. In about 20 to 25 minutes, we're going to bring up the investment team, get their opinion on what's transpired in the markets this year, how some of the income planning techniques can pertain to the investment portfolios that they create for you, our clients, and for those of you who aren't clients, the important things to understand. But first and foremost tonight, I want to take a second to recognize Memorial Day that we're going to be celebrating this weekend. So I am absolutely blessed to be able to do what I do every single day of my life. But I would not have that opportunity if it weren't for those that made the ultimate sacrifice that came before myself. So to those who have lost one, for those that have lost someone, I want to express my condolences and just take a moment to recognize those that have paid the ultimate price. I saw a quote this morning, it came through my email, and it said, "America's the home of the free because of those that were brave." And that succinctly put into place what Memorial Day really means. So when we talk about retirement income planning, and before I get into income planning, I do want to encourage everyone who's on the live stream to participate because I have the YouTube Q&A in front of me, and I'm going to be answering questions as we go along tonight. And I also have questions that were pre-submitted. We have some really good questions, so I look forward to answering them. So tonight's all about retirement income planning and tying that into the investment side of things, which Chris Paris and Charles Scavone, who will be up here in a little bit, will do that on behalf of the Oak Harvest investment team. So first and foremost, many of you know that dividend growth investing is a big part of what we do in one of our investment models here at Oak Harvest Financial Group. So I want to take a second to start at the top for those who may not know exactly what dividend growth stocks are or understand what I mean when I say dividend growth investing. So when you think about a company that's in the stock market, they have profits. Hopefully they have profits. Whenever that profit comes in, they can decide what they want to do with it. They can either reinvest into capital projects that they hope returns more and higher returns on invested capital, or they can take that money and pay it out to you in the form of a dividend. Companies that pay dividends, some of them have a long history of increasing that dividend every single year that they pay it. Now, not all companies increase their dividend every single year. Some will do it here and there, some will do it consistently, and some won't pay any dividends and will not increase those dividends if they do pay it. Every company, the board of directors tends to make these decisions, decides what they want to do with the cash flow that they have on hand. So you have different categories of dividend stocks, companies that pay dividends. So you have companies that have paid dividends for 25 consecutive years. You have companies that have paid dividends and increased dividends for 20 years, for 15 years, for 10 years. So when you reach that ultimate status of paying and increasing your dividend every single year for 25 years, you're known as a dividend aristocrat. Then you have, like I said, achievers and contenders and champions, all these labels that are put onto these companies, but it's a very prestigious status. So how does this tie into retirement income planning? Well, one, most of you understand that dividends in retirement can be a form of income. You have two choices when your stocks pay dividends. You can either reinvest those dividends and buy more shares. If you don't need income yet, this tends to be a very wise strategy because when you buy more shares, you're essentially dollar cost averaging into the market. And when you have more shares or when you buy more shares, that means you're likely to have more dividends down the road. Okay, so when you start taking income from your portfolio, and remember, as part of the retirement success plan, what we want to do is create multiple streams of income. So Social Security is a stream of income. Dividends can be a stream of income. Rental income from the private markets or the public markets can be a stream of income. All these different streams of income, and we want you living off the interest of your principal, not getting actually into your principal. So companies that grow their dividends or have a track record of growing their dividends could grow them at 0.5% per year or 1% or 3% or 5 or 10% per year. So I want to do some comparisons here. I'm going to pull up my spreadsheet in a couple of minutes. And for those of you, we have a lot of engineer clients down here in Houston, Texas. I'd say probably half of our clients are engineers. They come in, they have all their spreadsheets, they have everything all prepared. I know many of you don't like spreadsheets, so I made it a point to keep this one very, very simple, very clean. But I want to do a couple things. First, I want to show you the power of dividend growth stocks with a focus on the income itself, because that's what I'm talking about. The cash flow that these companies spin off that you receive in your account and has the potential to possibly increase over time. So dividends, and a couple disclosures here for compliance purposes, dividends are not guaranteed. Okay, a company can stop their dividend at any time. Dividend growth is not guaranteed. Companies can decide, you know what, we don't want to grow the dividend this year. They can decide to cut their dividend. So these are market-related investments that entail risk, but when companies have a long history of paying and increasing those dividends, they have a lot of incentive to continue to pay and increase those dividends. But I want to be very clear here, nothing is guaranteed when it comes to the stock market. Okay, so let me take one step back here. Part of what we do on the investment side is try to identify companies that we feel that have a good opportunity to not only continue to pay those dividends, but also we would expect them to increase those dividends. And this is how it ties into retirement income planning. So here at Oak Harvest Financial Group, we have the internal investment team that creates investment models that us as financial advisors can then use as part of overall retirement planning techniques and strategies. So many of you have seen Charles talk about SMR. Sales, margins, and the return on invested capital. So the theory goes, when a company has a very good product, they typically have high sales. If you have high sales, you typically can charge more in the price. When you charge more and you have high sales, you tend to generate pretty good profits. Well, companies that take those profits and then reinvest into projects that have higher returns on invested capital, expected returns on invested capital, well, then you have good management teams that are deploying capital to the best of their ability. So that means that they're creating economic moats around their business. And this creates a little bit of security in our minds as far as their likelihood to not only continue to pay those dividends, but increase those dividends. And what that means for you in retirement when we build these customized portfolios is that we can start to plan, although it's not guaranteed, but we can start to plan for income that could potentially increase throughout your retirement. So the first part of this income planning, and this is my favorite part, I invest a lot of my money this way, and we invest for clients this way. So Eric, if you could go ahead and switch over to the laptop, I want to hop into the first spreadsheet that we have here, and I promise this is a very simple one. Okay, so how does it look on the screen over there? Is it fairly visible? Okay, so what we have here, very simple. We have $1 million investment account with a current yield of 3% and then a hypothetical dividend growth rate of 5%. So when we talk about SMR, we talk about building these diversified equity portfolios where we have multiple companies in different sectors of the economy. We want to keep a focus on position sizing here so we don't get too overly exposed to any one company in any particular industry. But when we build a portfolio that's focused on dividend payers that have a history and an expectation of increasing those dividends, we want to try to target for a 3% average growth rate to those dividends, maybe a 5% or a 7%. Again, this fluctuates because nothing's guaranteed. But I want to show you the power of this and how it ties in to retirement income planning. So we take the $1 million with a current yield of 3%. Growing at 5%, those dividends, here's what the starting income looks like. It's $31,500. But when we're trying to keep up with inflation here, we're trying to have an increasing income. We see going out here, year 20 of retirement, that $30,000 starting income, irrespective of the performance of the market or those individual stocks, in this hypothetical example here, the increasing dividend income is up to $68,760 per year. Now, this is starting with a 3% yield, with those dividends growing an estimated of 5%. So we've had a lot of clients come in over the years and they say, Troy, you know what? I have, this stock and this stock and this stock in my portfolio, and I'm earning 6% yield on my portfolio, or I'm earning a 5% yield. Or they'll come in and they say, hey, you know what? I want to actually, you guys to build me a portfolio that makes 5%. So what I want to do is a comparison here. And before I make this switch, so year 20 of retirement, starting with a 3% yield and growing at 5% annually, year 20, we're up to $79,500 of income. Couple things to understand. When we start with a higher yield in retirement, we don't typically get the same dividend growth. There's multiple reasons for that, and I'll let the investment team get into it when they come up here. But let's just say they grow that dividend at 1%. And personally, I think that might be generous, but let's just kind of look at the numbers here. So yes, we start out with a higher amount of income, but because we're not getting that same type of dividend growth, when we come out here to the same year 20, we're at 61,000. So 61,000. Now that is, I believe the other one came in at 78 grand. So that is a significant decrease in income from the interest of your principal. Now, we can play around with these numbers any way we want, but the big thing I want to point out here is that the $1 million, the initial investment, I didn't assume any type of market growth on that invested capital. So it could go up in value, it could go down in value. If we're investing in companies that we expect to perform well over time, we would anticipate that your capital balances would increase over time, but it's an unknown. So if we just focus on the dividend, and we do this a lot of times when we have an annual review with a client that has a dividend portfolio, especially after last year when equities were down. Bonds were down, equities were down. It's always important to kind of refocus on the tools that we have in our portfolio that are working towards a larger goal in retirement, which is providing retirement income, and in this case, providing increasing retirement income. So we refocus that conversation to why we are invested in this particular model, and it's about the increasing income. So when dividends are paying out and they're increasing, if the capital balances of your principal, if your invested principal, if it goes down because we enter into a recession or whatever happens, the impact to your dividends is typically unchanged. No company says, hey, our stock is down 10% this year, we're going to cut our dividend, or we're going to not increase the dividend. What matters to the board of directors that makes these decisions about the dividend payouts is the free cash flow that they have. If companies have the cash coming in, this comes back to SMR, right? If you have a good product, you can have higher sales typically. Higher sales, you tend to be able to charge more, higher margins. So you have an inelasticity to that product, to that pricing. So I came back to my college days there, my economic class. That was a good one. I didn't say it properly, but I came back to it. So when people have a high demand for your product, you typically don't have to compress your prices in order to still sell it, even if we enter into a mild recession. Point here is that when you have an economic downturn and your stock prices go down and the portfolio value you have for retirement goes down, we found that people have a lot of solace in retirement with the fact that, hey, my income is still increasing. If we look year over year and your income was $42,000 last year, and now let's say it's $47,000 as a hypothetical example, the account's down 10% or 15%, or let's say it's an aggressive account and it's down 20 or 25, but that income is still coming in. That really helps you sleep at night, from my experience. That helps you understand that, this is a strategy that we can depend on to an extent. Stock market, again, not guaranteed, but we can depend on that income. So we found that really helps people start to feel comfortable with the overall market. Okay, so big thing to point out here. We can start with a higher yielding portfolio, but higher yielding stocks typically do not grow those dividends at nearly the rate that companies that have lower yielding stocks, I'm talking 2.5%, 3%, tend to do. So that's the first thing. Now, the second part of income planning, and I'm not going to go into Social Security too much. Okay, guys, we can come off the spreadsheet now. Just The second thing I want to talk about is Social Security. And then I'm going to come back to the spreadsheet and show you a combination of increasing dividend income as well as Social Security combined. So when we start to look at step 2 of the retirement success plan, which is income planning, it's not just about the investments that we have and the amount of income that they can generate. It's about how can we allocate the money that you've accumulated across multiple asset classes, focus on generating enough income so that you don't have to get into principal, but we have to make those allocation decisions about how we spread the money around with respect to your decision around Social Security. So Social Security can be well over $1 million, $1.5 million, $2 million, even more for a married couple. If you're single, go ahead and cut that in half. But if, just to put some numbers to it, let's say you've worked your entire career and you're a single person, you have $3,000 of Social Security a month, which is a little bit below the maximum that you can have. That's $36,000 a year, times 10 years, that's $360,000, times 20, that's $720,000, times 30, that's over $1 million of income from Social Security. Now, what I didn't do in that calculation was the COLA, the cost of living adjustment. Historically, Social Security has increased around 2.5% annually. Over the past couple of years, we've seen some pretty good increases to your Social Security income. But when you look at the increases there to Social Security income, it's much more than $1 million in total income received. So we have to make that decision with respect to your investment portfolio, how much income you're taking out. We have to understand the nuances there. And most of you who've seen a lot of the YouTube videos, who follow this channel, who are clients or are familiar with Oak Harvest Financial Group, you know I could talk about this subject as well as a lot of the relating subjects for a very long time. But I want to make sure I get through this and also bring up the spreadsheet, but I want to make sure that take a look just to see. Okay, so I don't have any questions over here. Do we have any questions submitted so far, guys? If you haven't submitted a question, anything that I've said so far to you that you may not understand or you may have a question about, go ahead. I do have some pre-submitted questions. If I have to get into, I will. But I do want to make this interactive. I did have some things prepared. But if we have some questions here, go ahead and put them through, and I'd be glad to talk with you. Okay, so I'm going to come back to the computer, and I want to just show the increasing income from not just a dividend portfolio that we talked about earlier, but I also want to now add Social Security into it. All right, are we live on the spreadsheet? Okay, so I'm not going to spend a lot of time on this one. It's a bit more involved, but very, very straightforward. We have the same annual income from dividends that I just looked at before. So this whole side over here is the same. A little bit smaller starting yield at 2.5%, but the dividend's growing at 5%. We see in this column here the increasing income from the dividend portfolio based on a $1 million investment. Now, over here, I just simply added a $36,000 Social Security check from one spouse, a $21,600 from another spouse. That's $1,800 a month. And we see these two combined incomes coming to $59,000. And then I've added the total annual income from the dividends, which again is an increasing income stream, and the Social Security, which is an increasing income stream. So when we get into building retirement income plans, what we want to do is create multiple streams of income. You see how we're starting to get there now. We have one Social Security, two Social Securities. Granted, we didn't build that, but we're optimizing the decision that you make in regard to electing when to take Social Security with respect to your other assets. The dividend stream, the increasing dividend stream tying in. So now we have three streams of optimized increasing retirement income. We come over here to column N and we see the total or the sum of these three streams of retirement income. And again, we're starting with just $1 million in this portfolio over here. So we start to see how this adds up. And when I slide over just a bit further, I put this column in here because I don't want to get into taxes. The next live stream we do will be about tax planning. I'm doing a series of videos right now on YouTube about the retirement success plan where we start with an overview. We go to step 1, the allocation, step 2, income, step 3, tax planning. Just want to quickly show you an estimated 20% tax rate. Even though we have this income over here, we're still paying a significant amount of taxes. So this is why step 3 of the retirement success plan is critical, because it doesn't matter how much income you generate or how much that income increases. If you're not keeping that in your pocket, okay, it's not as important. We need more money in your pocket in retirement, and the goal with planning is to help you live your best life. And we do that by generating multiple streams of income, hopefully tax-free or tax-efficient, and living off the interest of your principal, not getting into the base of everything you've worked your entire life for. Okay, so any questions about dividend growth stocks, optimizing Social Security? I do have one pre-submitted question for Social Security. We're going to bring the investment team up here to jump in about 5 minutes, but I want to give you guys an opportunity to ask any questions. Okay, so I'm going to jump to can a married couple, wife is 64, husband is 62, take wife's Social Security at 65 years old, and the husband takes spousal benefits? When the husband turns 70, then flip it. Husband claims his Social Security and wife claims spousal. So unfortunately, no. So that's used to be what we called filing a restricted application or a file and suspend strategy. That was taken away back in 2015, and Joe Sheldon submitted this question. So no, you cannot do that anymore, unfortunately. But if you have other assets, like most of you do that are watching this, you can take Social Security and still optimize that around your other assets, income distribution strategies. So, okay, I tell you what, a lot of these other questions can be tied into the investment team and what we're going to talk about in the second half of the show. So we are going to go ahead and bring up Chris Paris and Charles Scavone. No applause from me.
Yeah. Thanks, Joey. Thanks for the applause over there.
Yeah, we have a special guest with us tonight. So.
Charles's son's in town from California.
So Troy, you just got through describing an interesting program, and I was sitting there listening to you, and it just seems like I would characterize it as an all-weather type of product, of fund to use that suits a lot of our clients' needs.
It does. It's ultimately not just our clients, but pretty much anyone in retirement or entering retirement. Obviously, we have a specialization in building those portfolios that focus on those particular characteristics and have those attributes that we can analyze and try to build. But yeah, it's very much all weather. Even if you look at the stats, and I don't want to go too deep into the stats here, but dividend stocks over longer periods of time. Ned Davis Research, I know, has a really, really good study out there about this. Companies that not only pay dividends, but increase those dividends over longer periods of time tend to not only keep up with the stock market, but even potentially outperform the stock market.
Sure. And the other thing, excuse me, that you said that I don't think should be underemphasized is that not all dividend stocks are equal, right? Many times clients are interested in the highest paying dividend, right? They're always searching for the highest yield. And a lot of times companies that are exhibiting that characteristic are sort of at the end of their life cycle, right? The dividend is high as a result of bad math, and in many cases it's the fact that the stock price has gone down so low because they're over-levered, have been returning capital back to in the form of dividends as opposed to reinvesting, excess profits and cash flows. And so just when that particular dividend stock yield looks nice and juicy, it's just about to get cut.
Yeah.
Right. So it makes a whole lot more sense to focus on the underlying fundamentals that drive the corporate behavior, the economics, and everything that provides that dividend growth.
Down here in Houston, a perfect example has been Exxon over the past few years, right? So Exxon strapped for cash. Oil prices were down, revenues were down, profits were down. We have plenty of clients from Exxon that come in and they say, Troy, you know what? They stopped our 401k match. You know what? They've been borrowing money for years to pay that dividend. Now oil prices go through the roof and, the record profits, they're being attacked again politically. And, but they're back in the money and guess what? They're paying all that debt off. So that's a unique example, right? A lot of those high paying dividend stocks, they're, just skating by the skin of their teeth. And a lot of times the reason they are high paying dividend stocks is because, let's say they pay a $5 dividend and the stock was 100, that's a 5% dividend, but the stock goes down to 50.
Right.
And then all of a sudden that same dividend now is a
Sure.
much larger percentage based off that 50. So
Yeah,
I'm sorry. I'm going to say one more thing, and then we'll let our chief investment
that's
officer actually speak. So you gave a great example, right? You spoke to it a little bit earlier. When Chris and I are looking at these companies, you would see that when we build our portfolios, we build them one stock at a time, but in doing so, we tend to gravitate towards particular sectors of economic sectors of the market. And those tend to be sectors which are much more resilient, regardless of the economic condition, right? And so they have the ability to weather the economic storms that occur. You gave a great example of a company that's very cyclical in nature and is not able to be an all-weather company and doesn't necessarily fit kind of what we're looking for.
yeah, absolutely.
Yeah, and what I was going to say is this is a super timely subject, because if you're out there and you have a portfolio and you open it up right now, you're going to look at it and you're going to look at the TV and you're going to say on TV, the NASDAQ composite, which is largely technology stocks, largely low or no paying dividend stocks, it's up 15 to 20% year to date. Those stocks were out of favor last year. You're going to see the S&P 500 is up maybe 7.5%, 8% year to date. You're going to see that dividend growth stocks, which are up maybe 0 to 3%, and you're going to see the highest paying dividend yielding stocks, the AT&Ts that have low to no growth, are down 7 to 8% year to date. And there's this massive dichotomy year to date, just like there was last year. It's flipped.
Right.
It's flipped. And you're going to say, well, why do I want to stay with this dividend growth model? It's because not only at the individual stock level, but the market level over time, including the S&P 500, reinvesting those dividends over time, your dollar cost averaging in a down market over years and decades, not over months and quarters, and you're buying more of a lower priced asset. So when things do turn around, you have that compounding effect.
And what's really, I think, cool about that is we always talk about having a long-term perspective in stock market investing. Well, that is always in reference to the price of your stock, right? The price of your stock goes up and down. But as you saw on that spreadsheet that I just went through, your income may start at $30,000 a year, right? But if you keep the focus, let's say your dividend stocks are down 5% or 10% or 20% this year. If you keep the focus on the long-term capital, or not capital appreciation, but income appreciation potential, I showed you in that spreadsheet over a 20-year period, the income starting at $30,000, 3% yield, and growing up to $78,000 over that time. Now, how many of you right now watching, if I told you, and this isn't guaranteed, of course, it's the stock market, but we're talking about dividend stocks, which tend to be, historically speaking, a bit more dependable than maybe the value of particular stock prices movements over the next 5-10 years. So how many of you right now, if I could say, you'll start out with $30,000 of income, and in 20 years, it'll be up to $70,000 or $80,000 of income. Oh, and by the way, you didn't touch $1 of your principal. And not only did you not touch $1 of your principal, but if the stock market increased in value over that 20-year period, your $1 million very well could be 2, 3, 4, maybe 5 million. Even at a 7% average rate of return on your capital, that $1 million starting balance, in 20 years, you're looking at about $4 million on top of that income you've been receiving that entire time. So it's a great strategy, but like we say, there's pros and cons to everything, and it's not the be-all, end-all. It's just a tool that can be incorporated into an overall retirement plan. And even though we've kind of focused on that dividend strategy and Social Security a little bit tonight, I don't want to lose the focus that it's so much more about the plan that you have in place. Let's say you have IRAs and non-IRA accounts. Where are you putting those dividend stocks? Well, typically that depends on your plan, because they're going to be taxed differently depending on where you place them. How are your other stocks? Where are they placed? Or how are you investing them? When are you taking Social Security? What are you doing from a Roth conversion standpoint? What does the tax situation look like later? So all these pieces need to fit together into an overall investment strategy. And dividend stocks are just a tool. Okay, Chris, So today was an interesting day in the market, and it's been like this for, most of the year, really. So the S&P 500 was up about 0.8 or so. The NASDAQ, NVIDIA just blew it out of the water. NASDAQ was up 1.7 or so, and the Dow was down today. So
It was.
before we got into this conversation, or before we started tonight, I don't think any time over the past 12 to 14 years, really, when the Fed was printing money and interest rates were zero, you would know better than I, but I can't remember a single day where we had the 1.7 to the up, negative to the Dow, and then it's just a divergence.
Yeah, there's probably been days, but most of them I think have been this year, where you'll see the growth stock complex, which is all tech stocks, the top 10 technology names in the S&P 500 being up. Then you kind of get the rest of the S&P 500 being flat, and then the high dividend stocks, which there's a lot in the Dow Jones because they're older companies generally being down. It's been a lot of that this year. What's kind of amazing, and I have to look at the exact numbers, but before we walked into this meeting and stuff, if you look back 52 weeks, year over year, I think all the averages are the exact same level. They're all essentially flat with last year at this time in May, which kind of blows me away. And it tells you that, chasing whatever the strategy that's working for the last 6 months is not the optimal thing. You need to have a diversified portfolio. If your advisor puts you in a basket of growth stocks as well as a basket of dividend growth stocks, that allocation should be set for a longer period of time, for your years, not for months and quarters, because equities are long-dated assets. Their returns are historically very positive over long periods of time. If we start to shorten the time period, we start to increase the volatility, we start to get really kind of crazy variability in the returns.
The Wall Street has created so many different products that are so narrowly focused and labeled in things such as smart beta, or we just kind of laugh at that, and our audience needs to realize, exactly, these are financial services companies that have, they take some degree of intellectual capital, put together a product that's pretty low cost to do, and they'll roll it out. And if they can create a captivating story surrounding it, they'll sell a bunch of it. And that's what they do, and that's their business. That's fine. Our jobs here, though, are to discern what is meaningful. And that's what we do, I think, that's different than others, because as opposed to just allocating towards these different slices of the market, we will take a more fundamentally driven approach that looks at the tenets of corporate profitability, which, as Chris said, is what drives stock returns over time. And that's the formula that we would use as institutional fund managers managing, very large mutual funds. And it was our guiding principle that allowed us to navigate all the ups and downs of economic cycles, market cycles, fads, whatever it may be.
So we have a raffle coming up, but before we get into the raffle, you said something there which I'm not going to allow pass without having the opportunity to trademark our quantimental. So yes, we do focus on the fundamental analysis, but Charles has coined a term, quantimental, and I think it's brilliant, honestly, because it starts with, first and foremost, focusing right on the fundamentals, making sure SMR is taken care of, and then from there, really taking a look at a top-down approach as to what is the Fed doing? Which way are the winds of the economy blowing? What things out there should we be aware of that could possibly alter not just the fundamentals from an SMR standpoint, but maybe just the direction of institutional cash flow, which could favor one sector over another, possibly?
There's a lot of things that come into play, but it's important to remember that, there's an awful lot of data out there that we have to go through, and although we sometimes will think we slipped an artificial intelligence chip into one of, in Chris's head or our other team member James's head, it's important to know that we utilize a lot of technology to help us focus quantitatively on what's most important, those stocks or those companies exhibiting those traits, and then we have to go in and really dig in, and you can't. Artificial intelligence is an interesting subject, but you have to have the human capacity behind it to come up with the ideas.
All right, you said it twice, AI. That sounds like a segue. We're going to get into AI in this next one, but first we're going to do a raffle. Have you guys done it already? Do we have a winning name? Gordon Bowen. So Gordon, what we're going to do is reach out to you. We have your information. This is going to be a gift card to your favorite restaurant. May not be a gift card. I don't know how this actually works, but we're going to reach out to you, and they're going to coordinate somehow, get you some type of food at your restaurant, your favorite restaurant. Okay, you said it, AI.
Sorry, yeah, careful what you ask for.
I mentioned earlier, NVIDIA kind of blew it out of the water. Chris, we had this conversation earlier today. Charles, you were there as well. And I had a client ask me this morning as well. Okay, are we investing in AI? How do you invest in AI? Is it something someone in retirement that's worked 35 years, 40 years, accumulating all this money, should they be speculating in a technology that still has a lot still to prove, right?
He brought it up. You can answer this one.
Things roll downhill, as we like to say. Some of the other companies. Yeah.
You said things.
Yeah, it's interesting. It's interesting how things evolve over time and how people label things, right? So, not to diverge too far, but we spend a lot of time on conference calls and we listen to what companies are saying, and it's like their investor relations people all tell them, they all come from the same school. They have a meeting, right? Early on, they're like, "Hey, this mentioning AI really worked well in our call. Make sure everybody mentions it," right? And so it's pervasive regardless of whether you make toilet paper or computer chips. So we here, and Chris and I, in our background in the investment industry, we're always trying to figure out, what are the best tools to use to help us manage these massive amounts of data. And so we're increasingly using computer and developments to help us. Will you get to a point where AI can, manage your fund? That sort of. And it's like, the answer is no. You need people to do that. To the point that I think that we're trying to get to. How do we here at Oak Harvest invest and take advantage of what's going on in AI? And the approach that we take is, we refer to it as the Levi Strauss approach, right? And it's as simple as this. During the gold rush days, a pretty smart guy named Levi Strauss was in San Francisco, and he decided that there was an opportunity to sell picks, shovels, and jeans to all those brave explorers that were willing to risk their lives, get shot in the back, with an arrow or a Colt 45 in an effort to discover gold. And, he says, I'd rather sleep in my bed at night and in my house as opposed to on a hard ground and risking my life every day. So he sold the tools that allowed the leading edge guys, the speculators, to do their deal. We take the same approach. We invest in companies that provide the tools, the resources that help support the development of all these really smart people that are out on the leading edge, that we hope they're all successful, but to us it doesn't really matter if individually they are. We invest in the companies that provide, NVIDIA, that provide the chips that support the computing resources. Amazon that has the cloud computing capabilities, some of the networking companies, even companies like Accenture that provide consulting to other companies that know that they need to implement AI within their business. So there is a much safer way of investing in AI as opposed to trying to figure out who is going to be ultimately the winner.
And I have some questions here. So obviously I'm not going to be developing AI anytime soon because I've been looking at a blank screen for a while, wondering why there weren't any questions coming through. And then I click the button and all of a sudden I see the questions. So I'm going to answer your questions in just a minute. But I had a client this morning and it's funny. So we went through, it's like an hour meeting, and he's retiring and he's been a client for a few years and finally pulling the ripcord, right? Calling it a career. And he's going out on top. I'm not going to go into details here, but this man has accomplished the crescendo of what he ultimately could have accomplished in his career, and it's just a very, very sweet moment. And very conservative, though. And at the end of the call, when we're getting done, he says, "Hey, Troy, just real quick, I know you have to go, but what about AI? What are we going to invest in AI? How are we handling that?" And it speaks to, for me, the excitement. I told him, I said, it kind of reminds me of the late 90s, the early 2000s there to an extent. It's about the excitement. And I gave him, what we talk about. Hey, how do we invest and take advantage of the profits that AI can bring to the table, but do so in a way that mitigates risk since you're entering a retirement and this is all the money you'll ever have?
Sure.
Yeah. AI right now in the markets is a little bit like the metaverse was 18 months ago, right? I will say AI is closer than the metaverse, because we're talking about data, and we're talking about programming computers to learn from data, process data, and then help your decision-making process improve. The NVIDIA chips have processing power that's magnitudes greater than anything else. There's a few other companies out there that are behind them. I think AMD, Broadcom, they're behind them, hoping to gain on them. But clearly NVIDIA has the lead because they have the software basis that a lot of these programmers are using to develop the algorithms and that help maximize the chips. This is going to be years in the making. That doesn't mean that NVIDIA is going to go up 25% every day or every month or every year for the next 10 years. That's not the way the world works. Go back and look at the internet bubble. Things ran for 12 to 18 months, and they peaked out. And the companies, Cisco's, was kind of the NVIDIA back then. Yeah. It was continuing to grow. Microsoft back then was continuing to grow. And the stocks went down for years because they had gotten to valuations and their return on invested capital was such that it peaked, right? People were getting on the phone, and this would be my concern with NVIDIA over the next 2 or 3 quarters, is that right now there are no salespeople at NVIDIA. There are order takers because people like Amazon, people like Oracle. That's right. It's exactly what you want. You want word of mouth advertising. It costs you nothing. People are picking up the phone. Give me 5,000 of your chips. And well, at what price? 40,000, 50,000. It doesn't matter. Put me in the backlog. And that's an infinite return on invested capital. And the stock was up.
Can't maintain. It's not sustainable.
You can't maintain it. And so even though NVIDIA's business may continue to grow, the next quarter and the quarter after that at extreme rates, at some quarter in the next year, 18 months, you will see a peak in the order growth, you'll see a peak in the revenue growth, and the stock will peak. Yeah. It will peak. And their business won't have peaked, but the business momentum will have, because they can't get enough chips, or so many people at Amazon or Facebook, Meta, have called them up. Or my concern is that maybe there's some backdoor ordering for some countries that aren't supposed to be ordering these chips, and they're labeling, graphics controllers for gaming. Who knows? Because we've seen that countries get around these things, right? The flow of information is global now. So, not that NVIDIA will not go higher. I think it hit almost 400 this morning, but you got to watch for that incremental.
I'm going to get into the questions. I have several questions here. I want to ask both you guys. Go back to the late 90s. Is there any company from the late 90s that the NVIDIA story right now reminds you of?
Wow. Yeah, there's probably a lot of them, but I remember sometime, usually in communications equipment, company, you would see just a massive quarter. Like they would do just like I remember Ascend Communications.
Cascade and Ascend.
Cascade and Ascend.
Yeah.
They would report this incredible quarters and have this huge backlog. But that was it, right?
Yeah.
That was the peak. But and most of that stuff was never delivered, and stocks just, they, like Chris said, they peaked out.
And that's the concern, is that your salesmen aren't selling. They're taking orders. And that's a great thing when it's happening, right?
Yeah.
Inbound calls, your marginal return it's infinite because you're not doing any advertising. But when that slows, the stock will peak. Even though the revenue will grow, the margins might expand some.
Yeah.
The stock will peak, and it will be a relative underperformer versus the S&P 500 for
Years,
quarters
probably.
and years,
Yeah.
right?
Yeah.
And
Yeah.
it's not because it's a bad company. It's just because that marginal return on invested capital that is the very end of the SMR peaks.
You almost don't get any better than it is possibly right now.
And it's happened to great companies. It happened to Walmart. It happened to Microsoft, where if you go back and look at a chart on Microsoft or Walmart, they grew earnings for a decade, 15 years, at the same rate they had, well, on Walmart they had for the prior decade, but each dollar they put to work was making a little bit less money. So instead of returning 20%, it was 19%, and then it was 18%. And people are like, oh, that's great. But relative to the market is pretty smart, and it says, I'd rather put my money in the index.
Not only that, it's projecting out the diminishing returns on that invested capital, and so you discount future cash flows and you have a lesser stock price. Okay, so a couple questions I want to jump into real quick. Do you see any issues with having part of your Roth IRA money in fixed annuities at the current payouts? So always like to disclose we cannot give personal advice here. So this is more of a general question. So I'm going to answer it generally, what I would do. So fixed annuities can be great tools for someone in retirement. You want to make sure you have the appropriate tool inside the appropriate account, though. So I don't know your risk tolerance, but generally speaking, fixed annuities aren't going to grow as much as other investment opportunities. So when you have a powerful tax-free account like a Roth IRA, it could make sense to consider something that could grow at a higher rate over longer periods of time than fixed annuities. With that said, let's say you're 70 years old or 65 years old and you don't like the stock market. If you can make 5% on a fixed annuity tax-free, hey, that's not a bad deal either. So it's circumstantial, but me personally, I like to have a little bit higher risk items inside my Roth IRA, only because, well, one, I have a longer time frame, but two, the marginal return on that invested capital, because it's in a tax-free environment, will pay greater dividends down the road. You like how I did that? That was
Beautiful.
pretty good. Okay, one more question real quick here. How often, so this is from Lewis, how often do you recommend reallocation? This is going to be for you guys. How often do you recommend reallocation in terms of dividend stocks in my portfolio? Don't want to end up overtrading these, and should I look at fundamental internals or price action as triggers?
Yeah, well, so as I mentioned earlier, we build these portfolios one stock at a time, right? And so we're looking for these particular attributes. But as we do that, and as it's completed, we do take then a top-down view of that bottoms-up portfolio construction to see if those two views, what we've created, match. And if they don't, we make adjustments. And then as Chris derives what our market view is in our forecast, and we make sure then that as that forecast changes, that the composition of that portfolio changes accordingly. So and that's the basic tenet of active management, trying to make sure that each and every investment within the portfolio, consideration is given to its potential return, risk versus return, given what our longer term view is, and we change it.
So instead of having just a stock reallocate or rebalance every quarter, every year, when you're actively managing and analyzing the cash flow statements, the income statements, the balance sheets, understanding the business models, have experience with the management teams, understanding the history behind these companies and the industries that they operate in, as well as how the economic winds could possibly impact those key characteristics that determine long-term capital appreciation of the stock, you don't want to just have a stock rebalance time. You want to base the decision on the quantamentals.
Exactly. And you think about it. All right, so sometimes people get a little bit confused because what we describe is a very, I think, thoughtful, structured process, but it's not static. Capital markets are anything but static. And so your process has to be dynamic in nature, but within particular guardrails that help guide you.
All right, we're going to come back to that. And so I don't forget, capital markets aren't static, but to some extent, this is what I want a couple more questions, just want to answer pretty quickly. They're dynamic, but I want to talk to you guys about, for really the past 15 years, how they have almost been static, and all you had to really do was buy an index, and you're making, excellent returns, but how potentially that environment has changed. So before we get into that, Stan Grant says, Stan, how you doing? How are Roth conversions indicated in a year of low income versus high income years? So briefly, what I want to tell you, Stan, here is when we look at tax planning and converting money from your tax infested retirement account to that tax free Roth IRA, it's not just the year of income that you have now, it's understanding how much should we do at this particular point in time, but how does that we need visibility into the future. When we extrapolate those numbers and run all the different possible scenarios of how much and when we can convert to a Roth, how do we optimize those decisions? So, but the direct answer to your question, if that's what you're looking for, if you're in a lower tax year, most tax professionals, CPAs would tell you that's a good opportunity to take advantage of the Roth conversion. From a financial planner's perspective, we don't need to just understand what's happening today. We need to have visibility into the next 10, 20 years to help you compare or understand the decisions that you're making today, how they impact your life in the future. So excellent question. One more. So someone says, with respect to diversity and dividend stocks, I have a difficult time reconciling this approach with successful investors like Warren Buffett with very focused portfolios. Okay, so I'm going to answer that one. I'll give you all time to come back, give you guys an opportunity. Look, when you work 40 years and you accumulate $1.5 million, if you invested in 5 stocks, go for it. Go for it. But when you have a plan that, generally speaking, it's more intelligent, I should say less risky, to be diversified, have a well-balanced portfolio. But if you have the risk appetite and the hunger for, or the appetite for that volatility, and maybe that was a little bit more direct than I should have been, Bob, but ultimately, yes, you can make a lot of money if you take the Warren Buffett approach. But when you've accumulated, from my experience, sitting with thousands of clients over many, 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 many years, I could possibly go to jail if we did that, right?
Well, here's the difference between you and Warren Buffett, and it's not the billions he has, it's the billions he gets every month, because he has a business that's the insurance business, and people write him checks every month, right? So yes, he owns Apple's, I think, his largest holding now. If Apple goes up and down, he's not that concerned about it, because every month he's getting checks from Geico for billions of dollars, and he has the luxury that most people in retirement don't have with regards to just letting that cash build up and sitting around and waiting for a recession and waiting for people to call him up and say, hey, Warren, I need your money. I'll give you 12 or 15% for a preferred share like he did during the financial crisis, and getting that deal. The rest of us, the other 99.999% of us, don't have that luxury. We don't have that luxury.
But I will point out this one other thing, though. So Warren Buffett is a fundamental value investor. Right. And everything that we've set up here, Bob, is in direct correlation to, or positively, to that. That's exactly what we're talking about.
When I hear, I'm sorry, but when I hear that sort of question, I envision somebody that becomes very attached, very passion. They love, emotionally attached to a particular stock, and that can be a terrible thing, right? We have, if you ask a lot, ask Chris or I, what's your favorite stock? Whatever's working today, right? It's a process.
Whatever's green.
Yeah, it's a process. We're always trying to optimize and find the best possible opportunity. If you have just too much of an emotional attachment to a particular stock, I guarantee you will just ride it flaming into the crust of the earth, as I like to say. I've just seen it so many times. It's sometimes it works, and those are the ones that you hear and you see. They're a maverick, they're an entrepreneur, and God bless them. I'm glad it worked out for you, but it's typically not what happens.
But the reason Warren Buffett can not be diversified is he has a business that is writing him checks every week, every month, and providing him billions of dollars, such that if he's wrong on airline stocks, which he was, if he's wrong on financial stocks, he can sell them, and he still has cash coming in that he goes on to either let it build up and wait for the next at bat, or take his next at bat whenever the economy's in a recession. The rest of us don't have that luxury. I don't run a business that generates billions of dollars of cash flow to make those huge bets, and if they don't work out, have a fallback of I still have this massive cash flow coming in.
What we have instead, the corollary to that in terms of what we do is we build these portfolios and we adjust position sizes such that they are large enough to be meaningful to the portfolio's return, but not so large should we make a mistake, which we do from time to time, or something unforecastable occurs, and that position could go down considerably, and it doesn't impair the value of the entire portfolio. It's the same analogy.
Yeah. But I will tell you this, Bob. I had a conversation with a client this morning, the AI client. If you want to peel off a certain section of your portfolio, as long as you have visibility into the decisions that you're making and how they impact your security and your family's security, if you want to peel off 50K, 100K, 200K, whatever that number is for you, and have a higher concentrated position into companies that you feel have the opportunity to really, really grow in value, that's completely okay. What we do, though, for a living is, first and foremost, create a plan that protects your quality of life, your standard of living, because it's not necessarily about the return on your principal, it's about the return of your principal, right? Our clients are in retirement, they're near retirement, and our most important job, our most sacred responsibility is to protect everything they've worked their entire life for. But if you want to peel some money off and enjoy that, absolutely, go for it. Okay, so we have one more raffle coming up here. While Brianna is getting the name, Larry says, do you have clients in other states than Texas? Yes, we do. We have clients from all over the country in many, many, many states. And so, yes, we do. Joshua Austin. Joshua, so you have won the second raffle. So thank you very much for registering, Joshua. And for those of you who did not register, I know many of you showed up tonight. When we send these invitations out, once you register, that qualifies you for the raffle, because what we're trying to do there is get your information, and we're going to send you an email. We'll put you into the email flow. If you don't register, no problem. Tune in anytime. We love to have you here. But by registering, you kind of join part of our family. You get to see what's going on. You get updates about these webinars, these live streams and some of the other events that we do. So make sure to register if you did not tonight for the next live stream. We do these every single month. And all that we're going to do is take your information, send you, put you onto the email list, and we're not going to bombard you, I promise you, but we're going to give you impactful information and material to hopefully improve your retirement. So one more question that I want to come back to. Did we cover what I said I wanted to come back to there, or has it been so long we've already forgot?
No, we kind of cruised over it. I think we got excited about something else.
Yeah, the Warren Buffett question, because so that was a good question though, Bob. Thank you very much, because it honestly, it invoked different emotions and responses from all of us.
Yeah, it is a great question, but I'll tell you, that, you know what happens when you ask an investment manager, why don't you own Berkshire Hathaway in your portfolio? And it's because, well, you could decompose the best elements of it and own the individual stocks, but more than that, it's a psychological thing. Chris or I would never want to admit that there's somebody actually that can manage money better than we do ourselves, which is kind of what you're implying by owning his stock.
Yeah.
So,
Okay, so Purple Rain 409 says, my spouse and I are both 52 and have 1.8 million in IRAs, 400K in brokerage, 40K in Roth. First, congratulations at that age for accumulating that amount of wealth. I can't figure out how, when to do Roth conversions for tax planning. Help. Congratulations. I mean, that's a tremendous amount of wealth at your age to have accumulated. Great job. I can't give you tax advice without obviously understanding your particular situation, but I would recommend talking to either a financial advisor in your area who specializes in this, possibly your CPA. And if they're not able to help you, feel free to reach out to us. We can see if we can help you as well. Okay, going to slide down here one more time, and then we're at past 7 o'clock. So Ed from Katy says hello, Mr. Ed Rossi. How are you?
Hey, Ed.
So Ed, how did graduation go? So Ed, so many of you don't know, so obviously it's an inside joke. So Ed sometimes does these live streams with us. He's a certified financial planner here, professional, certified private wealth advisor, professional here at Oak Harvest Financial Group. He was supposed to be on tonight's live stream with me doing the income planning, but his son graduated high school. Very, very proud moment for the Rossi family. And Ed, so glad you chimed in. I think you can tell we all have pretty big smiles on our face. We miss you. We love you. I'm still waiting for your question, though. So let's see what you got, buddy. Okay, so transitioning kind of to wrap this up. We talked about dividends. We did get into S&P being the divergence and the indices.
Yeah.
Charles, talk a little bit for just a couple minutes here, and then Chris, I'll give you a moment to kind of come up with some final thoughts. The difference between being a passive investor from, let's say, 2009 to 2020 to the environment that we're entering now, where we're starting to see a divergence between the NASDAQ, the Dow today, NASDAQ up 1.77, the Dow down 0.8 or so,
Right.
the S&P somewhere in between. Those indices represent different sectors of the economy, different types of stocks.
Mm-hmm.
We're entering into an environment to where, hey, is it still the best thing to just simply buy an index and hope for the best?
Yeah, it's a great question. It's very important, and it's at the heart of, I think, our beliefs, how we operate. And so here's how it goes. During the period of time which you described earlier, the decade earlier, you had generally every fiscal and global monetary authority lowering interest rates, cheapening money, pumping liquidity into the system. And as a result, what you saw was that the behavior of stocks was all very much the same. They were all exactly correlated. It was an asset class. And as interest rates came down, the mechanics behind it were such that, longer dated or, stocks traded as one. And so it didn't make a whole lot of difference if you perform, the sort of analysis that we've talked about. And so that created the ability for index funds, passive investors, to really go out and market what it is they do, which is create a cheap product that allocates every dollar of an investor's money on a percentage basis to 500 stocks if it's the S&P 500, or the 1,000 stocks if it's the Russell 1000, regardless of the investment merit of that particular company. And so what's happened, though, now, and what's different, is when the Fed began this process, when inflation flared up, the Fed starts raising interest rates, and global economies now have become they're not all operating in a synchronized fashion. And everybody's sort of looking out for their own interests. What's going on in Europe now, they're focusing on their issues. The U.S. is focusing on their issues. And so what you're seeing now is a greater, what we refer to as dispersion of returns of the individual stocks. These correlations aren't holding as one would expect to happen in this type of environment. And thus, we believe, and it's been proven, from an academic perspective, that when this sort of situation occurs, active management matters. You can add value to a portfolio through stock selection. And that, we believe, is going to occur, we think is going to be a continuous process over the next 10 years.
No, it's not surprising. You start to see when money isn't free anymore, you start to see some of the warts from different countries, different economies, different companies. When money's free and you can make massive amounts of mistakes, let's say you're a management team of a large corporation,
Right.
and you can borrow money at 0% or 0.5, let's say, and invest, and your return on that investment is 2%.
Right.
You're still making money.
And if your sales or if your margins are low, you raise a bunch of debt, buy your stock back, and it's just math. Then
Yeah,
whatever the amount of earnings that you have is going to be spread across a smaller number of shares. You've financially generated earnings per share.
Engineered. So there's been a lot of financial engineering going on, not just in companies, but in the countries, right?
Agreed.
United States of America, as well as every other country out
Sure.
there. Final words, Chris?
It's, since the Fed started raising rates finally, 18 months ago or whatever it is, people have called us up saying it's so volatile. The market overall, believe it or not, volatility has been going down for almost a year. So there are a lot of individual stocks that are volatile. And when you turn on the TV, almost every medium you watch, they're going to try to grab you with attention and trying to grab your emotions to make you feel like everything is volatile. What I try to tell our clients and our prospects is, one of the best things you can do is probably step away from the TV, step away from CNBC, Bloomberg, Fox News, turn it off, talk to your financial planner, look at the numbers and look at the math, and, are you going to be okay? There is no perfect investment philosophy, whether it's growth, value, dividends, aggressive growth, momentum. They all come in and out of favor and flavor. And, if you sit down with your financial advisor, develop a relationship, trust them, and believe that they have your best interest at heart, look at the math. And, the markets, we're going to have a recession sometime, right? We actually went through one last year in the financial markets. The stock market was down 25%, peak to trough, in 6 months. That's a recession. You can't avoid them. But can you plan for them with your financial advisor and take some of the stuff that Charles and I are worrying about all the time and losing our hair about, by listening to earnings calls all the time, out of the equation? Yeah, that's where Troy and the rest of the financial planning team comes in, and they're the hand to hold with you when things are going up and down. Charles and I are here to talk to you, but
I'm going to start saying, "Oh, you want to talk to Chris? Oh, yeah, extension."
But what Charles and I are doing is a lot of and I hate to say it, it's the minutia of behind the scenes. And the bigger picture is what your financial planner, what Troy and the rest of the team are doing, with you in the meetings, with the computers and the math behind it.
There's one question here, just to close this out. There was one question earlier, and here it is. So with the uncertainty of solving our economic crisis and how the market responds, I often hear that long-term the market will rebound. What if we are approaching our 80s and are not sure how to protect our 60-40 allocation? What would you recommend? And I'm about to sneeze, so I'm going to try to fight this off. So this comes from, Ellis. So Ellis, very simple question. What do you want and what do you need? Okay? What do you want and what do you need? Do you need to have 60% of your money in the stock market exposed to that risk? I can't answer that question for you. I have no idea how much money you have, where your income is coming from, what you're spending, but you don't have to just be 60-40 as a general rule of thumb, because that's what the rest of the world has said for decades. For a lot of people out there, it's a very inaccurate allocation based on your current lifestyle, your needs, and the income that you need to withdraw. So I would just ask you to think about, what do you actually need and what do you actually want? And then talk to somebody that can help you put some numbers behind those particular questions. And if you're spending $50,000 a year, $70,000 a year, and you have $2 million, hey, CDs, treasuries, they're not a bad idea. So you don't need to take the risk if you don't want to, but answer those questions. What do you need and what do you want? And then from there, you should start to have some clarity, and a good financial planner can help create visibility into the tools that could make sense for you and your family. So we're going to close out tonight's show. I want to thank everyone for tuning in. I started the show recognizing Memorial Day. I want to finish the show recognizing Memorial Day because Charles, Chris, myself, we've dedicated our lives to the financial industry, but many of you out there have dedicated your lives to the military, and many of you out there know someone who has passed away, who has given everything that they have, so Charles, Chris, and myself can do what we do here every single day. And that's what Memorial Day is about. So we don't want to close this out without recognizing how grateful we are for the opportunities that we have. And only in America could we do this and enjoy every single day because of the sacrifices that were made from those that came before us. So thank you all. Have an excellent Memorial Day, and we look forward to seeing you next month on our live stream.